Here is something that should make any investor stop and think. Over the past 2 years, a handful of AI-related stocks have delivered returns that took decades for previous technology waves to produce. NVIDIA, at its peak, became one of the most valuable companies in human history. Microsoft embedded AI into nearly every product it sells. The excitement is real, the money flowing in is real, and the transformation happening inside corporate America is real. But so is the danger of paying too much for a story that has not yet fully played out. So which is it? A bubble ready to burst? A breakout that still has years to run? Or something messier than either of those clean narratives? That is exactly what we are going to work through today. And by the end, you will have a clear framework for thinking about this rather than just another hot take. Let's start with why this question matters so much right now. AI stocks are not a niche corner of the market anymore. They have become the load-bearing wall of the entire S&P 500. A relatively small group of technology companies, the ones most directly tied to building, enabling, or deploying artificial intelligence, account for a disproportionate share of the index's total market cap. That means when you own a broad index fund, which most retirement savers do, you are already heavily exposed to the AI trade whether you realize it or not. This is not 1999 where dot-com mania was isolated to a specific sector that most traditional investors could sidestep. AI valuations are now baked into mainstream portfolios everywhere. So the debate is not academic. It directly affects your 401k, your brokerage account, and your financial plan. Now let's build the bull case, because it is genuinely strong and deserves to be taken seriously. The core argument for AI stocks is that we are watching a genuine platform shift, the kind that only happens a few times per generation. The internet was one. Mobile was another. Each of those waves minted enormous long-term winners for investors who held through the early volatility. The bulls argue that AI is not just another software upgrade. It is a fundamental change in what computers can do. They can now reason, write, code, diagnose, design, and analyze in ways that were pure science fiction a decade ago. The revenue numbers are starting to back that up. NVIDIA's data center business grew from roughly $10 billion to over $40 billion in a single fiscal year. Microsoft's Azure cloud platform accelerated its growth rate specifically because of AI services layered on top of it. Alphabet, despite competitive pressure, is seeing AI features drive incremental usage and monetization across search and cloud. These are not projections or promises. They are reported earnings. Beyond the headline names, enterprise adoption is accelerating in ways that matter for durability. Companies across healthcare, financial services, legal, and logistics are deploying AI tools to cut costs and improve throughput. When a technology starts saving real businesses real money at scale, it tends to become sticky. It moves from discretionary spending to critical infrastructure. That transition is already underway, which gives the bull case a foundation in actual cash flows rather than just future potential. Capital expenditure commitments also support the longer runway thesis. Microsoft, Google, Meta, and Amazon have collectively announced hundreds of billions of dollars in AI infrastructure spending over the coming years. Companies do not make those commitments lightly. They are betting that demand will be there to justify the build-out, and their internal forecasts tend to be more conservative than what they announce publicly. The bear case, however, is not just noise from skeptics who missed the run-up. It raises questions that deserve honest answers. The most serious concern is valuation. At various points in the last 2 years, several leading AI names were priced at price-to-earnings multiples that assume years of flawless execution. When you pay 60, 80, or 100 times earnings for a company, you are essentially borrowing growth from the future and paying for it today. That works beautifully if growth never disappoints. But any stumble, a quarter where revenue misses estimates, a competitor that gains ground faster than expected, or a macro slowdown that causes enterprises to pause AI spending can cause those multiples to compress sharply and quickly. High multiple stocks do not fall 10% when they disappoint. They fall 30 or 40% because the entire price was built on confidence in a perfect forward path. The concentration risk is also worth naming plainly. The AI trade has crowded into a very small number of stocks. When institutional investors all hold the same positions for the same reasons, the exit can be chaotic if sentiment shifts. We saw a preview of this dynamic in early 2025 when news about a more efficient Chinese AI model briefly rattled the sector. NVIDIA dropped nearly 17% in a single session before recovering. That kind of volatility is a feature of crowded, high-expectation trades, not a one-time anomaly. There is also the question of who ultimately captures the value that AI creates. History suggests the answer is rarely who you expect. The internet created trillions in economic value, but most of the money did not go to the companies building the infrastructure in 1999. It went to companies that did not yet exist or were tiny at the time: Google, Amazon, Facebook. The same dynamic could repeat with AI. The companies spending the most on infrastructure right now might be enabling a generation of competitors and new entrants who will eventually capture the margins. The picks and shovels trade is appealing, but it is not automatically safe. Power and compute constraints add another layer of complexity. Training and running large AI models consumes staggering amounts of electricity. Data center capacity is constrained by physical infrastructure, power grid limitations, and the time it takes to build new facilities. These bottlenecks could slow deployment timelines and create cost pressures that compress margins even as revenues grow. So where does that leave a rational investor who wants to think clearly rather than react emotionally? The honest answer is that both narratives contain truth. This is not a clean bubble like tulips or a clean breakout like the early internet. It is genuinely both, depending on where you look and what you pay. Some AI valuations are stretched beyond what even optimistic earnings trajectories can justify. Others represent real businesses growing real revenue at prices that, while not cheap, are defensible given the growth rates. The challenge is that they often carry the same label, AI stock, which causes people to either buy everything uncritically or dismiss everything defensively. The most useful lens for individual investors is to separate the theme from the price. The AI theme can be completely real and still produce poor investment returns if you pay too much to access it. The dot-com collapse was not a repudiation of the internet. The internet was every bit as transformative as its believers claimed. But investors who bought at the peak of 1999 waited 15 years to break even because the price they paid embedded too much optimism too early. With that in mind, here is a practical framework. First, look at what percentage of your existing portfolio already has AI exposure through index funds and broad tech holdings. Most investors are already in this trade more than they realize. Second, if you want targeted exposure, prioritize companies where AI is contributing to current earnings growth, not just future potential. Revenue today is worth more than projected revenue in 5 years. Third, be honest about the multiple you are paying relative to the growth rate you are expecting. A stock trading at 50 times earnings needs a lot to go right for a long time. That is not impossible, but it should require conviction, not just enthusiasm. Fourth, diversify within the theme. Infrastructure plays, enterprise software companies with AI integrations, and adjacent industries being disrupted all offer different risk profiles and entry points. The AI revolution is not going away. The technology is real, the demand is real, and the winners over a 10-year horizon could be extraordinary. But the path between here and there will include corrections, rotation, disappointments, and surprises that no one currently sees coming. The investors who do best will not be the ones who were most enthusiastic at the peak. They will be the ones who stayed disciplined about what they paid, diversified intelligently across the theme. and held through the noise without confusing short-term volatility with long-term invalidation. That is the AI stock debate in full. No clean verdict, but a much clearer picture of what questions to ask and what risks to watch. If this kind of breakdown is useful to you, subscribe so you do not miss the next one. And as always, nothing here is personalized financial advice. It is education and perspective to help you think better about your own decisions. One quick note before you go. This content is for education, not financial advice. If this breakdown helped, subscribe for weekly investing research and market explainers.